If you ever go to the East Coast, there's a place called the Tiny Tavern in Cape Canaveral, and you can get $2 Amstel lights or something in little mini mugs. And then out back, they have horseshoes. But instead of throwing horseshoes, you throw toilet seats.
Okay, that's
fantastic.
That's
Perfect. Welcome back to the Futures Edge podcast. I'm Jim Uriel. As always, the brains behind the operation and co-host Bob Iacchino. Today we have someone who I hate to interview because, as you guys know, I try to fancy myself as one of the smarter guys in the room. And when I'm with Cameron, I rarely ever can. She's the Chief Investment Officer of New Edge Strategies. Thank you for coming back, Cameron.
Oh, thank you, Jimmy. Thank you, Bobby. Thrilled to be back.
Okay, let's play some games first, some nonsense. Where's the last great vacation you've taken?
I haven't taken a vacation in ages. So
Why
I'll
is that?
take recommendations of where I can go on vacation.
I would say Stan's in Goodland, Florida would be a good
That's what I would say as well. Stan's good. Key West is my go-to spot to just kind of check out. For people like us who are kind of like, high energy people, going to Key West for 35 years for me has always been like this weird escape. It's like going to another planet. Have you ever been, Cameron?
I've never been because it's a long way from Orlando. It's a
long way from anywhere.
Yeah, from anywhere.
Mm-hmm.
Florida's a weird state. I've lived there 3 years now, almost 3 years. And driving back from Chicago, you hit that sign that says, "Welcome to Florida." I'm still like 7.5 hours away from home.
It's crazy.
Insane. It's insane how far it is. And I'm 3 hours from Key West, actually more, 4 hours from Key West.
Yeah. Key West, I was going to start spending longer stretches of time there over the winter, but it's gotten so expensive and so crowded that I'm probably not going to do. But all of Florida's gotten expensive and crowded. So what's the
I'll tell you guys this, and actually we can segue into housing off of this, but we recently bought a house, and we bought a house that somebody defaulted on because of interest rates. We weren't even looking to buy, and we were just kind of looking. You know how you just kind of look? And then all of a sudden this one popped up, and I'm like, that seems underpriced because it's in a new area. It's all new construction. And I'm like, I've seen these before, and they were much higher than this. So I went to the sales office, and they're like, yeah, somebody defaulted with the higher interest rates, so we're cutting this by 30% because it's built and we just want to close on it. And we closed 3 weeks later, literally.
That's pretty rare now, simply because, and I'm actually writing about it for this week, which is that if you look at the percentage of mortgages that had adjustable rates going into this hiking cycle, it's only about 5%. And you compare that to prior to the great financial crisis, they reached a peak of 35% back in 2005. And so that's why when rates rose, people were forced out of their homes because they were forced out of their own mortgages. You get priced out of your existing mortgage. And if you have financed your mortgage at a really low rate and you're locked in, then you don't get forced out. But what's interesting is that as rates have risen, people have started creeping back into adjustable rates, essentially just to get their current payment down. So I bet that's an example of somebody who probably originated that mortgage or that loan early last year, got an adjustable rate and wasn't counting on rates going up as much as they did over the course of the year.
Yeah, so we moved to a brand new home, Jimmy, and literally we picked none of the finishes, none of the stuff. Luckily, they upgraded a lot of it, but quite frankly, 30% off the top for new construction. Sure. It's like, well, hell, do we walk away? We don't walk away from that kind of thing. You just don't.
Well, that's the dream, not having to pick out any of the stuff. I'm glad about that. But Cameron, so I always argue too, one, about the adjustable rate thing, and two, the market positioning going into the great financial crisis versus now. Back then, your brother-in-law, who was a plumber, owned 5 houses that he was rehabbing. Anecdotally, I did not see that sort of buildup of everybody being a house flipper going into this. So it's like, back then when we lost 40 to 45% in the housing market, that seemed to make sense to me as people were starting to hit bids as rates adjusted and people started losing jobs. I did not see the same formula this time. Do you agree?
Yeah, look, if you look at things like the percentage of mortgages that were originated to some prime borrowers were significantly higher prior to the great financial crisis. And part of that is a function of all of the regulation that's happened post GFC, where you've seen only mortgages really being originated to the best buyers, with those with the highest credit ratings. So that's helped dampen things. And I think you're right. The speculative activity, it was starting to reach a fever pitch. I think in 2021, you're starting to see a lot more homes purchased for investment reasons. That has plummeted in 2022. I think that if the Fed hadn't raised rates and kind of let things run for a little bit longer, that's where you certainly would have seen more kinds of instability brewing. But that raises a really important point about the Fed's reaction function going forward, because a lot of people will look at the inflation data and say, let's just look through the shelter because it's so skewed by all these different measures of owner's equivalent rent and it lags and we can just look through it. But I would argue that the most direct line from Fed policy, easy policy, to inflation, the one that you can actually say Fed does this, inflation does that, was on housing, meaning that because the Fed kept interest rates so ultra low, it made affordability still very attractive, even as prices surged. So as prices surged, that eventually worked its way into higher rents, which is now what's working its way into inflation data. So if I'm the Fed, which I'm clearly not, but if I'm the Fed, I would be concerned that if I cut interest rates into what is already a very tight housing market when it comes to supply, that I could actually reignite this bubbly kind of behavior within housing, simply because it would it would spur that sort of price increase and the potential for housing related inflation to come back. So I don't know what fixes the scenario other than just more construction. But then, of course, more construction is difficult to do when interest rates are high and activity is low. So we kind of get caught in this loop. But I do think that is something, when we think about the inflation data and housing, we really should consider the Fed's reaction function, just because they could cause it to be worse pretty easily.
Hold it. So a lot of, I thought some smart guys, high-end analysts, when they saw the CPI number, but take the PPI out of it for a second, they're like, okay, well, if you take out owner equivalent rents and you substitute it for a more real time, like Zillow's rent calculation, then the inflation picture changes. You're saying that that's bullshit and we shouldn't do that calculation, correct?
I don't think that it's, I don't think that it's bullshit by definition to be able to say, look, like if we remove this, what are the other components doing? But even that super core CPI, that core services X rent to primary residence and owner's equivalent rent, so XXXX, even that super core CPI, it moderated to about 0.3% on a month over month basis, which is slightly slower than December. And then it moderated, and then it's still at 6.2%. So overall services are still well above the Fed's target. So even if you strip out, the housing, and look, if you look at the month over month CPI, that core number, about half of the month over month increase came from housing. So that's, of course, it's important. So if you take half of the CPI and say, okay, I'm gonna use a number that's half of that, then yeah, you'll get a lower number. But I would say that it's important for us to say, okay, inflation breadth is still high, trimmed mean inflation is still high, and thus the end result is, I don't think the Fed is going to be willing to call the all clear on inflation by substituting Zillow numbers.
So Cameron, I've got a couple of questions for you, but I want to ask some viewer questions first. I actually got two of them from the same person, a guy by the name of Tim McLean, who's actually, he's a friend of mine. He's a fan of the show. He watches all our podcasts. He was very excited you were back on. One of them, he said, ask her what the hell a TAR is. My daughter is graduating from Rollins.
Oh, I know the answer.
What a TAR is. I don't know what a TAR is. What the hell is a TAR?
It's a sailor. So Rollins College is where I went to undergraduate and my business school. And for whatever reason, the mascot is a sailor. And it's because there used to be a Navy base in Orlando. And they would do certain training and drills on the lakes where Rollins is positioned. It's really beautiful. It's all set across these beautiful lakes with Spanish hanging moss. So the mascot is from the sailors who used to come and visit the campus when they had their time off and likely wreak havoc.
Yeah, sure they did. They slept on the tar is what I'm getting by the end of the day. So and then he sent me a serious question, and he's a very successful commercial real estate lender, banker, and he's a pretty astute investor. But he said to me, another question for Cameron, any thought on bank balance sheet? They're loaded with securities yielding 2 to 3.5% in a 5% rate world. Should investors be concerned?
Oh, I don't know if I have, that's a good question. I don't know if I have perspective necessarily on that or know exactly what securities he's referencing. But what I would say is that I don't think necessarily that bank balance sheets are the source of the systemic risk this time around. It doesn't mean that you can't see bank balance sheets eventually become the source of systemic risk. Usually, regulation, it's always good to remember, regulation always fights the last war. It's like a general, right? Always fights the last war. So a lot of the regulations post the great financial crisis have made banks far more healthy, far more stable. But I probably am not close enough to know if there's been pockets of new innovation within banking balance sheets, which is usually where you see the issues, new innovation that could cause systemic risk. So at this point, we're not seeing that as a high probability, but I could dig into it more.
Okay, so this wasn't my question, but I just want to follow up to that then. You said it's not the source of systemic risks this time. So in your opinion, what is the source of systemic risk this time?
That's the $1 trillion question. Look, I would say that we've had 2 back-to-back, and actually 3, I think you could argue 3 back-to-back big debt crises, from the 1990s savings and loan crisis, the 2000s tech bubble, which was actually a short-term funding crisis in the commercial paper markets, and then the great financial crisis, which is of course housing and derivatives and all of that. So 3 of the last major recessions, 3 of those were all driven by the balance sheet. I don't know if the coming recession that we have is necessarily driven by balance sheets. It's more akin to the kinds of recessions that we had prior to the 1990s, which were driven by Fed cycles in response to inflationary cycles. So maybe that's what this next recession looks like. Now, what I would say is that you always sow the seeds of the next crisis during the prior boom, right? And what's interesting, I talked about the adjustable rate mortgages, and you can also see dynamics within the commercial paper market where, because interest rates were kept so low for so long, companies who would have normally borrowed commercial paper, so really short-term dated paper to fund things like working capital, or if you're Enron, to make long-term investments, hence that's why Enron blew up, is because they borrowed short to fund long. Right. If you look, commercial paper balances plummeted in the last 10 years, plummeted. And that's because long-term interest rates were so low. So why borrow short-term if you can lock in long-term funding? And I think that the reason, if we look at corporate balance sheets and consumer balance sheets, you can make a really good argument that they're less sensitive to short-term interest rates than they were in the prior cycle, which is why you haven't seen some big, huge blow up like you would normally see when the Fed raises rates as quickly as they have. But here's the fun little caveat, which is that because rates are now higher, companies and consumers are now looking for ways to essentially get their short-term borrowing costs lower. So they're borrowing on variable rates because you can get it a little bit lower instead of locking in these higher rates. And they're used to rates going down. So if this keeps happening, what you'll see is commercial paper starting to creep back up off of a low base. Adjustable rate mortgages are starting to creep back up. This is us sowing the seeds of the next issue. And it only becomes an issue if the Fed stays higher and tighter for longer.
Can I go? Oh, because I wanted to add something to what you said, because you talked about systemic risk in the banking industry. And I always, when I try to describe it to people, and I've said this in speeches too, the mortgage-backed thing back in 2005, 2006, every bank had the same damn position on that was also fueled by the fact that Fannie and Freddie were in that same market providing a floor to those securities. You see nothing that's tantamount to that at this juncture, right?
No, look, it's always hard with the derivatives market because it is invariably opaque.
Right.
So sometimes these are the things that you only start seeing them being an issue until you start seeing the cracks. But we do know regulatory basis, banks don't have the ability to be as risky because of the capital ratios in derivatives. And so there is hope there that maybe you kind of rein some of that in, but I wouldn't rule out some kind of systemic issue brewing. But like I said, it's likely going to come from a place that we don't expect, not from the place where it was the last time.
Yeah, I remember when it was like 2 years after the financial crisis and the London whale thing broke up. Was that JP Morgan or
Yep,
Morgan Stanley?
yep.
And everyone's
JP
like,
Morgan.
see these banks. And I'm like, guys, that's one bank. If they're idiots, they should blow up. We should be celebrating moronic regulatory procedure in one bank. The problem is when it all happens to all the banks at the same time. That's the thing that could knock us back to the Stone Age.
Mm-hmm.
So here's my question then. So we've seen that everything changed this week. Before this week, I would have said I cannot envision a scenario where inflation starts to move higher again. Inflation started to move higher again. So I'm wrong.
You didn't read my note from 3 weeks ago, Jimmy?
I did.
No, I should have read your note. I did read your note. I read most of your notes. I swear to
This
God.
one, right?
But what is going with rates at this level right now? What is the thing that's going and supply chains healing and the money supply starting to come down, obviously very, very slowly. What is going to fuel this next round of inflation if it picks up more than modestly?
Okay, so let's break down inflation into its 3 key buckets. The smallest bucket is durable goods. That's 9% of CPI. Durable goods are cars, washing machines, all of it. That is pandemic inflation. That's supply chain issue inflation. If you overlay durable goods CPI with the cost to move a container from Shanghai to Los Angeles, it's the same darn chart. Those are the supply chain issues, and that is the transitory part of inflation. So that reached a peak of 18% in February of last year and is now running at -1% as of December and January, about the same. So that's round tripped all that inflation. And it's important to remember that means that in 2022, durable goods were in disinflation the entire year. So now that we're all talking about disinflation this, disinflation that's done. It happened, and it will likely go negative, and it already has, stay negative. But the path from going from 18 to -1%, that degree of difference is unlikely to change. So you're starting to see things like used car prices start to tick back up. So you could see that durable goods inflation actually start to reaccelerate. The second bucket is about 31% of the CPI, and that is your non-durable goods. That includes food and energy in the headline number. And that, of course, is very sensitive mostly to gasoline prices. And if we look, that was in disinflation all through the back half of last year because gasoline prices fell 40% from June to December. And I think that you can make an argument that the December low in oil prices and gasoline prices may be the short-term nadir in those prices, because if you think about there being a put from SPR, Strategic Petroleum Reserve, buying from the US government at below 70, OPEC plus wanting to cut production below 70, and then the fact that peak maximum lockdown in China, which means peak maximum or trough demand for oil in China was in that November-December timeframe, that would lead me all to think that that probably is the low unless we go into some kind of recession. So that was in disinflation all through the second half of last year. And so now it's starting to turn back up because gasoline prices are turning back up. The last portion is services. That's 60% of the CPI. Services include a big portion of rent, about 30% of the overall CPI is rent and housing prices, shelter costs. So of course that is skewed by that dynamic. It should moderate through the remainder of the year. But then the other portions of services, things like transportation services, medical care services, that likely still continues to moderate because of just calculation factors. But what we're seeing is those continue to tick up and be rather strong. Transportation, I think like water utilities, other things that fall into the services side of things. So that is starting to reaccelerate as well, or actually never decelerated because the labor market's so strong. So I'd say look for reacceleration in durable goods, watch that closely. And then look for reacceleration in non-durable goods from gasoline prices, and then look for continued elevation within non-rent services.
Okay, before Bobby with this question, this is why you watch our podcast. They would never let her go into that depth because it takes long. This is why we're the best podcast. Thank you for that. You should drop the goddamn mic and just walk off the stage because that was brilliant. Bobby, what do you got?
Well,
I like that was a really subtle, nice way of saying you rambled. But
no, I'm not saying that. I'm saying I loved it. And a podcast, you're supposed to go in deeper depth. People who listen to that are coming out the other side smarter. That's kick-ass, in my opinion. I'm excited right now.
This is a long form conversation, and you do ramble, but not a bit of your rambling is unnecessary. It's not like you repeat the same thing like I do. I ask a question, and I ask the question 4 times, so I sound smart. But
I take 2 naps in a Bobby question usually.
I basically was the one I was reading was the one where you use The Price You Pay by Bruce Springsteen as your musical lyric introduction. That's what I was trying to show you.
I think I should probably do Led Zeppelin Ramble On.
No, not at all.
No, she totally rambles, but it's not rambling in the sense, not the definition of the word. And that actually brings me to what I'm going to say this, then I'm going to ask a question, and I'm going to let you go, because literally you have a brain that we call cognitively complex. Okay, so one spark goes to another spark, goes to another spark, and they're all related to the same brain. And that's why, like, you're so far the person we've had on the most, and you're likely going to continue to be the person we've had on the most, because it all matters. So from that perspective, from that brain, I don't think crude oil, not only do I not think crude oil has a floor, I think we'll see $100. And I'll give you a couple of reasons. The China reopening, I don't think is what people have hoped for yet, but I think it will get there. So we haven't gotten that boost in the actual numbers in terms of crude oil. That's my thing, right? In terms of crude oil demand, the Chinese demand has not increased at the rate with which speculators hoped it would, number one. Mm-hmm. Number 2, Russia's voluntary cut. Number 3, OPEC's going to probably increase production when we get increase their production quota when we get to $100 a barrel, because $100 a barrel is demand destruction. It's not a demand pause. That's when, you know, people like me who really like a V8 Mustang, it might look at a Tesla, right? Because it's just insane what it costs to fill the car up. But so they don't want it there, but they haven't reached the quota they currently have in place. They've hit it one time in the last 6 months. You add to that we're only 93 million barrels away from the spot in the SPR where legally they can't sell anymore unless there's actually a frickin' war or an embargo. Those would be the only 2 reasons they could legally do it. And we're only 93 million barrels from that. So they need to move away from that. We're going to buy somewhere below $70 a barrel and just buy the damn barrels, because this being an oil guy is the kind of thing that keeps me up at night. That after this next 26 million barrel sale that was mandated by Congress, I don't know if you guys know this, Congress sells oil to fill budget holes and other shit, which again, I can't even talk with Jimmy about this. He's going to get upset. So a Republican Congress is not going to give that to Biden. They're not going to say, no, we can postpone the other sales because I know you're in a bad spot, Mr. President. They're not going to do it, right? Because there's the political ball in play. So the part of CPI that is influenced by energy, you said is what percentage?
Well, the gasoline, the energy is in total, I think about 9-10% of
Right, but
CPI.
influenced by it. There's other sectors.
There's other
I wanna
sectors, and look,
understand
and it bleeds. That's the thing with oil prices, is that it bleeds into other sectors because transportation costs go up, and that starts getting into everything. Manufacturing costs go up. If you look at what happened in Europe with the when they had their spike in natural gas, they had to shut down fertilizer plants because you couldn't make money making fertilizer, which is very energy intensive. And so fertilizer prices went up in response. You had the same thing with iron ore smelting. So it definitely gets into other areas when you see spikes in oil prices. That's
Okay, so-
exactly what happened in the 70s, right?
Yeah,
It
so-
started out contained and it spread.
So I have to say this. I don't have a crude oil long, by the way. I'm not long crude oil. I want to make sure everybody knows that, because I'm talking about how it's going to $100. Don't have a position because I don't have a time frame on it. So taking that one more step further, if I'm right about crude oil, okay, where do you fall in this slowly building argument that because of the funding pressures of a, say, 5.25% terminal rate on the US Treasury, is the Fed just going to accept a higher rate of inflation? Where do you fall in that conversation? They're just going to say, you know what, we think 4% is fine, we're going to cut. Because the CME Fed Watch tool still has a 25 basis point cut priced in as the highest probability in December.
Well, don't forget that the Fed also, the Treasury borrows at different points along the curve. So if the Fed were to get rid of their inflation target for 2%, it would push interest rates higher. Even if the Fed is cutting at the short end, the long end would likely move higher simply because inflation expectations, which have remained very, very anchored for the long run, even through this whole inflation episode, you've seen the long run 5-year forward stay sub 2.5%. So the bond market believes that the Fed will get inflation to its target over the long run. And so if they go away from that, what happens is that if you think of the nominal interest rate as term premium plus inflation expectations go up, your nominal interest rates, thus your borrowing costs, go up as well. That's one of the other considerations when we think about that neutral rate for the Fed. So look, they have the neutral rate at 2.5%. They initiated that, I think, in 2010 and 2011, and I think they initiated around 3.5%. Neutral rate, by definition, is the rate at which it's neither stimulative or restrictive. And it's marched down all through that secular stagnation period, decade post the Great Financial Crisis. And now it's still at 2.5%. Well, how are we seeing a reacceleration in economic growth if the neutral rate is less, or is about half of where the current Fed funds rate is? There's an argument.
Because they're full of shit. Okay, go on. Yeah.
Yeah, but there's an argument as to why the neutral rate should be higher.
That's awesome.
That the neutral rate should be higher. But if they do say the neutral rate is higher, then does it exacerbate funding costs? Maybe there's some offset of that. If the neutral rate is higher, it means that nominal growth is higher, because the neutral rate should essentially equal nominal growth over the long run. So if it is actually in fact higher, then nominal growth should be higher. So that means more tax receipts that can offset funding costs. So look, there's a lot of things that this inflationary episode, these questions are raised by it to say, are we in a different world today than the one that we spent the last 30 years in, which is continued disinflation and continued falls in interest rates? And are we seeing something that really is a sea change, to quote Howard Marks? But really, it wasn't Howard. He should have noted it, because it actually comes from Shakespeare. It comes from The Tempest.
Fantastic. See, no matter what topic you bring up, Cameron knows more than you about it. But anyway, this notion that there's a neutral rate, that it presupposes that every other condition stays stagnant. It's a ludicrous notion, right? That at one point in time. Okay, good. Yeah. So let's bleed this into equities now. Obviously equities are having a difficult time as expectations for rates go higher. Is this fair? Is this, if the economy is doing as well as it is, should stocks be, and again, M2 money supply is still wildly high. There's tons of money sloshing around out there, even though it's been pulling back a little bit. Where do we go from here?
I don't think that it is the right valuation to pay a prior peak multiple. And I'm saying prior peak X the pandemic, because the pandemic was a rare time for valuations that were fueled by unprecedented accommodation. So setting that aside, the prior two cycles, multiples peaked in early 2018 at 18.5 times earnings and early 2019 at 19.5 times earnings. All through the prior 20 years, post the not quite 20, but post the dot-com bubble bursting. We never got above those valuations. Well, as of a couple days ago, we were trading at 18.6 times earnings. And that's with a Fed funds rate of nearly 5%, and with balance sheet contraction, with real interest rates at about 1.5%, with the Fed, with money supply now shrinking. It's still shrinking off of a very large base, but shrinking nonetheless. So I've been dubious of the ability for this market to see continued upside from valuations, simply because we'd have to go back to pandemic era territory to get upside that would be significantly higher from here. And that, in my view, would require very accommodative policy. Now, that's on one hand, that's the valuation side of things, which I think is tapped out. On the other side of things is earnings, and that's where you could see upside. Because if we look at where consensus currently sits today, it's about $220 a share for 2023. That's down 1%. That's down from expected growth of 9% back just a few months ago, or 6 months ago or so. So the market has moderated expectations a lot. But if we think about then, what if we don't have a landing? What if we don't have a recession? What if inflation remains elevated? Where you could see upside would be on the revenue line. Remember, earnings are a nominal number. So inflation is high, you get the benefit from higher inflation, higher growth. So you could see upside on the revenue line. If I'm remembering correctly, I think the street only has about 2% revenue growth expected for this year. So there's upside to that. Then it's a question of margins. And margins have been falling. And that's one of the reasons, if you look at this quarter, revenues were up 5%, but earnings were down 4%. And that's because of 100 basis points of margin compression. So you could have a scenario where the economy kind of keeps chugging along, but as margins normalize to pre-pandemic levels, you don't get that boost to overall earnings. And then, so it's a question. So just to put some numbers on it, I ran it yesterday and said, well, you probably can get 5 to 7% in a strong economic scenario. That gets you to $235 a share. That means today's valuation is closer to 17.5 times. So if I think in some weird world that I want to put a peak valuation on really strong earnings when the Fed's tightening, whatever world that is, I put 18.5 times on that, that would get me to 4,300 and change. And that's kind of like your best of the best case scenario. I don't think that happens, because I don't think you can have your cake and eat it too. You can't have strong earnings driven by good growth and good inflation and a peak multiple of a very tight Fed. I think it's one or the other. So, sure. Yeah.
So let's talk about the consumer then. One of the things I think you do best is sort of explain that part of it, that part of sort of the macro view. The consumer is now defaulting on credit cards at pre-pandemic rates, right? Mm-hmm. Auto loans delinquent at pre-pandemic rates. And I thought about that when I heard it on Bloomberg today, and I thought pre-pandemic wasn't that bad. So is that just sort of a click headline kind of a thing, or is something happening to the consumer we actually need to know about?
There has been fraying in the consumer, mostly the lower end consumer, for a year now. I think the very first time we spoke, we talked about Rent-A-Center and how Rent-A-Center, which is renting, buy, essentially it's old school buy now, pay later for furniture and TVs and stuff, that they were starting to see fraying within their consumers. And so that was really the tip of the spear of this. And the reality is that the consumer is going to remain strong and continue to spend as long as they have jobs. And even if we're looking at credit card volumes or overall debt, yes, they're above pre-pandemic levels to a new high. But if you look at them as a percentage of disposable income, they actually are below pre-pandemic levels and far below great financial crisis levels. So debt levels are not so onerous today that consumers are going to immediately have to tighten their belts. But I would say is that it's until consumers start worrying that they are going to lose their jobs. It's one thing if it happens somewhere in the headlines and it happens to, you know, the yuppies out in, you know, in California for the tech companies, right? Oh, it's not close to me, but it's when it's your neighbor. And then it's when it's your family member. And that's when you start seeing consumers really look around and going, you know, maybe I need to pinch pennies, and that's where you start seeing it's work its way through. But usually that doesn't happen until you see continuing claims and initial jobless claims really start to move higher. And those are both very low on a historical basis by seasonal standards, and they're below where they were in tight jobs markets of 18 and 19. So we have not seen fraying in jobs, which means that the consumer can just keep on spending and they'll continue to build up debt, but they still have headroom to be able to add more debt to their balance sheets. It will eventually become a problem. It's just not there yet.
You know, it's interesting. At the time in my life, Jimmy, and actually I'm saying this to you because it's kind of when we first met each other, at the time in my life when I was making the most money in my life. I can assure you it's not right now, but it was when Jimmy and I were on the trading floor you were like 4. So looking at it from that perspective, I remember back then, I'm like, I was making so much money every day and I still use my credit card. So I think of it from the perspective of, I mean, I tried to pay the thing off, but consumers themselves remind me and slap me in the face if I'm wrong of the US government, where look, we have the reserve currency. We can borrow as much as we want. And it seems to me that consumers have jobs, so they can use their credit cards as much as they want. They can use their home equity loans. I kind of have an anecdotal evidence of that in my own sort of social circle. You know, a guy refinanced his house, took out a cash refi. He's fine. He could make the mortgage. He's got all this money in the bank from the cash out refi, and he's just spending it. And it seems like insanity, but it doesn't seem to worry stock market investors.
Before Cameron answers, can I add something to your question? Because I also think there's a psychological component to this too. I think post lockdown, that I think there's a different like mentality of people, a more of a live for today mentality, and tomorrow is going to be a problem for tomorrow, Jim. What do you think of all this, Cameron?
YOLO.
Exactly.
Wait, that reminds me of like YOLO options being back, and we should probably talk about what's going on in the options market. But
that's a nightmare.
Look, I think that there is an aspect of you know, let's just live. We've been locked inside for so long, but you know, there's places like Florida that are about to be lapping 3 years of not having lockdowns. Lockdowns ended in April or May of 2020 for some states. And so I think that we're getting further and further away from that, as well as getting further and further away from pandemic era boosts to savings balances that are now being spent down. We know savings rates are now below pre-pandemic levels. That would point to consumers kind of pushing the limit on what they can do. The point though on that is that usually at the very beginning of recessions, when you start seeing this worry that they'll lose their jobs, savings rates go up, not down. So that would be kind of one of your red flags, is actually that savings rates go back up, because that tells you that broad consumer sentiment or consumers are getting much more scared and actually taking action. That there's an important point of all of this. All of the weakness in economic data, or the majority of the weakness in economic data, came from soft data in 2022, survey data, sentiment data. So for example, consumer confidence, awful all year. Consumer spending, okay. Home builder confidence all year, terrible. Home builder construction activity, okay. PMIs for industrial manufacturing activity, terrible all year. Industrial production, okay. So the real question is, if you see real hard data catch down to this softer sentiment data, or softer sentiment data start to move higher. And year to date, It's actually been that sentiment has been improving. Now, that doesn't mean that it closes the gap and we go back to gangbusters and that eventually you won't see hard data slow, but it's an important kind of caveat in interpreting the data from last year.
So is what you're saying is that the consumer themselves, the worker themselves, if they are feeling, they're the best barometer of their own job security, they can feel the wind change before they lose their job. Is that kind of what you said in there?
Yeah, I think that's, we've seen that in prior cycles, is that, when consumers start seeing other people really lose their jobs and not be able to get other jobs, that's one of the reasons why continuing claims and initial claims have stayed so muted despite these announcements for layoffs, is that job openings are still, I think, 3 million jobs higher than they were at the pre-pandemic peak. So if you get laid off and you want a job, you're in an environment where you have a higher probability of getting one compared to going to the great financial crisis where you lost your job, you got your pink slip, there was no jobs to be had. So this is still not an environment where a layoff announcement here or there is going to cause this systemic cascade. It will eventually, something will eventually happen, but it's just not there's no evidence of that yet.
Bobby,
can we talk about the manufacturing sector? So I was just looking at global manufacturing was flat globally. That's why I said global. Global manufacturing was flat in January after being
in the
down
globe
6 of the price. The global
Of the whole world.
It's not
the
the domestic
whole
one.
globe.
If I had a globe in here, I'd hold it up right now.
Every country together.
So,
Yeah, you get it, right? You get it.
so if you take half of the world and you add the other half, that's what I'm talking about, the whole globe.
I think, yeah.
Global manufacturing
Glad it's
flat in
Friday.
January, and I think that was kind of seen as a positive because they've been down 6 of the last 8 months. You see momentum in I'm going off of your previous history as sort of an industrial commodity analyst. Am I wrong in that characterization? But
An industrials analyst. I tried not to cover
analyst.
commodities.
Yeah. So
those are for the smart people. I was like, I don't want to know what TiO2 is doing. I don't understand that.
I did a Bloomberg interview the other day, and I told them that the intelligence quotient in markets starts with bonds. And then, by the way, I'm talking about, it goes bonds, commodities, FX, stocks. And he goes, well, commodities, you're a Chicago guy. I'm like, not anymore, just for the record. But anyway,
I don't know. You can take the boy out of Chicago, but you're never going to take the Chicago out of the boy.
As if somehow I'm not going to go get a cheesy beef at Jimmy the Beef Guys later tonight. A couple of places, by the way, James, that don't do a bad Chicago hot dog here. They actually get Vienna shipped in. Oh, I'm sorry, this is about
really. Yeah, if it ain't Vienna, I don't want it.
Manufacturing.
Yeah.
What do you see? Do you see trends? Do you see it slowing? What do you see?
I mean, if you look at the industrial companies and their earnings, I mean, they're great. They're really strong. There's a big divergence between the ISM PMI, Purchasing Managers Index for manufacturing names, and the relative performance of industrials. Part of this is a function of the fact that companies are now starting to see their supply chains heal. So Deere reported today, and they talked about how, yeah, there's still pockets of supply chain issues, but it's not like it was this time last year where you couldn't get certain parts no matter how hard you tried. And so that is starting to lower the impact of that cost inflation of the input costs for them. Now, inventories have gotten a lot better, have healed, where inventories were really tight for certain things. I think that there's still pockets of industrial inventories that are low. Caterpillar has talked about this, where there's certain machines that you still are having trouble getting your hands on simply because you had 2 full years or 3 full years of really disrupted production. So I think that there's that aspect that's getting better. And then you do have the potential for China reopening. Even there was a name called Allison Transmission that makes heavy duty truck transmissions. They talked about demand in Europe being better. So, you're starting to see maybe a little bit of signs that it's not, that it's not falling off a cliff. And part of that is just because maybe they didn't participate in the big upcycle like the consumer did over the last couple of years. I would note, though, just a point of caution, if you're dabbling within cyclical stocks and industrials, is that they are the area that has the strongest seasonal component. Sell in May and go away actually works for industrials and materials and semis and consumer discretionary. So you see the best performance in October through April, and then they usually really struggle through the summer months. And so just be careful, because what typically happens for industrials is that they get over their skis. I always call it this is why we can't have nice things, because they essentially price in all of the year's worth of growth into the first couple of months of the year. And so then what happens is you get into second quarter earnings season and you look through the summer and go, oh, I've already priced it all in, so there's not much more to do. And then what happens is that by the time you get to October, you're rolling your models forward to the next year, and that's where they start outperforming again. So you got to keep things on a fairly short leash in that area, just because you have this propensity to be very, very subject to seasonality.
So it sounded like from this whole conversation that you are almost kind of in a soft landing camp. I mean, you think the economy is still going fine. Are you? Is that the right characterization or no? Or just a delayed recession?
I don't like any of the characterization, because yes, you said the right word, delayed. What's missing from all of these discussions is the factor of time. And we have this kind of tendency to be very absolute in our definition of what's going to happen, which is it's an either or. We're either having a hard landing and it's happening today, or we're not having one at all. And I think that the reality is more like, okay, data's better today, which means that it reduces we're pretty much no probability of a first half recession and a much lower probability of a second half recession, which might mean a recession in 2024. And we can't really judge that until we get closer to 2024. Eventually, you'll see the impact of the Fed's tightening work its way through the economy, through the system, but it has a significant lag. Never forget that the Fed started raising rates in 2004. They stopped raising rates in 2006, held them flat, and it wasn't until 2007 that unemployment started going up. So in this debate of hard versus soft landing, all of this, we cannot forget the time factor, which is why this week's report, and it's cute, is going to be called No Land Before Time.
That is cute.
Remember the dinosaur movie from the 90s?
Yes, of course I do. Yeah. So hold it. So if you were chairman of the Fed, which God for us to be so lucky, do you believe if you just sat on your hands at this point in time and left the rate to be above whatever the damn neutral rate is that they pretend they think they know, would this eventually work itself out, or would you keep hiking rates? Do you believe there's an immediacy?
I think that,
come on in, Joyce.
Yeah, look, I think that the economy is less sensitive to short-term interest rates than it was in the past. That was our discussion of commercial paper. That was our discussion of adjustable rate mortgages, which I think effectively makes it harder for the Fed to be able to control economic activity and economic data, meaning inflation, with their policy, which would lead them to have much tighter policy than they would have in the past, because there's not as quick of a response to their policy in the real economy. So what ends up happening is that financial markets and interest rate sensitive parts of the market might react very quickly, but then the real economy may react more slowly. They don't have as much control over it, which would argue for this higher for longer kind of rate. Now, we don't know.
Stop for 1 second. Are you running for office? Are you hiking rates or not?
I thought I was just rambling. I thought I was the rambling man.
Listen,
I'm going to regret saying that.
over.
I know I'm going to regret saying that.
We're the
I already
Fed. You're
regret
the chairman. I'm giving Cameron, you're the chairmanship of our Fed. It's 10 minutes till we got to pull the lever or not. Are we going another quarter point hike or are we going to wait? Of course,
Of course we're going another quarter point hike, and we're doing another in June. We're not letting financial conditions continue to ease, because you have seen real evidence. You've seen real evidence of financial conditions easing, causing this reacceleration in activity. So just one example, Affirm. Affirm is a company that does buy now, pay later. Affirm is a company that really relies on access to cheap funding in order for its business model to work. Affirm raises a debt round in January when markets were wide open and liquidity was sloshing around, financial conditions were really easy. They raised it at a spread versus the benchmark rate of 270 basis points, and it was oversubscribed. And then 2 weeks later, they report earnings and the stock's down like 20% on earnings day. When financial conditions ease, funding markets open up and all companies can then get access to funding. And that's one of the reasons why you've seen companies go back and really tap debt markets. Similar thing is happening within housing. Financial conditions ease, interest rates fall, housing activity picks back up. So I think that you actually can say financial conditions, which are by definition very correlated to real economic activity and nominal economic activity, those easing have resulted in this reacceleration. So if I'm the Fed, I go, well, I don't really want this. I'm not comfortable with this. So I'm raising.
I love that. That's a perfect answer, Bobby.
Cameron, before I ask what would be my last question, is there any way I dig myself out of the rambling hole?
No, it's forever.
Yeah, I literally just
always.
Did you see Cameron give me the "I want to kill you" look when I told her?
I literally just looked up rambling on my computer on this side here, and you don't ramble, but I still don't even think saying that gets me out of this. She's not even smiling. From a perspective of my little conspiracy about the Treasury and the Fed with the rate hikes, and if the short end of the curve doesn't help the Treasury at all, because obviously they borrow on from different durations, different spots in the yield curve, then to me it's yield curve control, or it doesn't matter to the Fed. Am I nuts in either one of those things? By the way, I'm going off of a friend, a guy who actually trained me years ago, my first few years in the industry, sent me a text. Michael Taylor says the US Treasury cannot persist in a 5.5% short end past this year. I look at the outs for this to persist, and it's just about zero. Short US 2-year is now my biggest position. That's from Michael Taylor. And I'm looking at this, I'm like, go ahead, Michael, but the Fed keeps saying they're leaving it here. So you're literally fighting the Fed, which is what we grew up knowing we shouldn't do. So is that just conspiracy theory crap?
Yeah, I mean, look, if I were a rates trader, which I'm not, so I have no business in saying this, but if I were, the 2-year is one of those things where you want to see it break, because when it breaks hard, right? So like you get the initial downside volatility alert, and that's when you short the living daylights out of it, or you buy, or the yield, meaning that you're buying 2-year treasuries, right? So for us, when we're thinking about our positioning within our bond portfolios, we've taken the stance of we're willing to still be overweight this short-term paper, knowing that there's still potential for rates to rise, and so you could have some principal loss, but you haven't seen the movement in the 2-year yet to suggest that the Fed's about to embark on a very rapid easing cycle yet. When that breaks, that's the sign we're going into a recession. The 2-year will tell you. And the 2-year not breaking, this gets us back to the better way to interpret the yield curve. So the yield curve being inverted tells you nothing about the timing of a recession, just tells you that it's kind of possible. When it starts to reinvert, that's the timing of the recession, because it's the 2-year and it has to be a bull steepener. It can't just be it can't be reinverting because of a bear steepener. It has to be a bull steepener. The 2-year falling, that tells you that you're about to go into a recession.
Okay, I've written some things about this, and I want to comment on it too. It's because when the Fed funds curve starts saying to us that they're tightening, and then they're going to start to ease, they're going to ease by a quarter point. I call bullshit on that. If the impetus is there for them to ease, it's not a quarter point, correct?
Yeah.
So the Fed funds curve is wrong, and I hate saying that. Yeah.
Yeah, look, it is wrong, and it was so wrong 3 weeks ago. Oh my gosh. Like when we had this immaculate disinflation, soft landing narrative, and you saw and I posted a chart about it back, I think yesterday, you saw the Fed funds curve saying that the Fed wasn't going to get to 5% as of January 27th, wasn't going to get to 5% and was going to do 50 basis points of hikes in the back half of 2023. Under what condition? Under what condition would they do that? And what you've seen is a repricing. So now the Fed funds rate is now set to have a terminal rate above the median dot for the Fed, meaning I think it's reaching above 5.2, 5.3% versus median at 5.125. Now there's only 20 basis points of cuts baked into the back half of next year, this year. That's going to get unwound if this data continues to come in better than expected. So the Fed funds rate, I do not like it when people say the bond market is all knowing, because the bond market is just as wrong as the Fed is. The bond market changes prices, which is why yields change prices. So it's when the bond market starts flashing something wildly different than what the Fed is promising, like in 2018. Remember when yields broke down starting in November of 2018, Fed comes out and says, no, we're not even done. We're not even restrictive. And you saw the 2-year plunge, the 10-year plunge. Yeah, that you pay attention to, because the bond market's saying we can't take it anymore. And yes, what did the Fed do? They cut rates in 2019. But we haven't seen that kind of bond market activity yet. So I haven't believed the bond market all year. The equity market has, which is why you've seen valuation expansion. And that, I think, is what's starting to be unwound over the past couple of days.
And that's what we did, about 25 years of research or so. We're not done with it yet, but it seems that every time we have an inverted yield curve, equities actually bottom after the yield curve steepens back to its rightful position.
It does. Yeah,
we're not in a position where equities should be bottoming yet, if you look at history.
No, and look, there's also precedent of these cycles taking time to work their way through, because we haven't seen any kind of real impact on the earnings side of things. You know, a similar thing happened in the 2000s bear market, where okay, you know, we had the first portion of it, Fed tightening, and we took the air out of the multiples. And then what happened is that the real recession kicked in and the accounting scandals kicked in. And that's when you saw the second leg down within the market. So does that happen immediately? No, probably not. Not with this strength of this data, but could that happen eventually? Yeah. So what that might suggest is that maybe the distinct sharp downtrend is turning a little bit more sideways, and we oscillate and chop for a bit. Maybe, I don't know. Look, the path is going to be difficult to determine. What I do know is that as of last week, this was a very, very, very expensive market.
So to switch topics for a second. So it's Friday afternoon when we talk. By the way, we're an hour and I got a restaurant bar to run, and you have a life too. But what are you doing? Are you done working? Are you going?
No, I got to finish this no land before time paper. So.
Oh, okay. How long will that take you? Just a couple hours or no?
No, I'll get it. I'll get her done.
And so what are you doing? Do you go out tonight? Do you go out with friends? You going out to dinner, going out for drinks? What is your drink?
Oh, well, we've already talked about this. Remember, I said it was like a spa day. I love like a good cucumber juice with a little bit of tequila, mezcal, and some lime.
We did talk about that. That sounds fabulous, by the way. Good.
But this time of year, you want something a little bit more cozy. So we'll see. But
does that mean bourbon or red wine?
Well, it probably means bourbon, though I'm still reeling a bit because Grandma came to visit and we drank Sinatra smashes. And I think I'm still in recovery from that bourbon experience. So
I froze.
I think Jimmy froze.
Jimmy did freeze.
Yeah, I think he's saying goodbye anyway. Jimmy.
I can't believe my internet cut out right when I heard about Grandma visiting. Were you drinking with Grandma?
Of course, Grandma's 95 and can drink me under the table.
That's awesome.
Fantastic. That's outstanding. Good. My 95-year-old mama passed away a month ago, and we sent her off with the Irishest goodbye. I mean, I was hungover till Wednesday after the weekend. It was a fun time.
It's the only way to go.
No doubt about it. Okay. Anything else, Bobby? We're gonna wrap up. Thank you so much, Cameron. It's always
no,
so
I'm
much
good.
fun to talk to you. I really appreciate
anxious to get off this because I'm in trouble for the rambling comments. So
No, by the way, and I love when Cameron rambles. I was just trying to be funny.
Oh, hang on. You agree she rambles. It's not just
No,
me.
she doesn't
Right.
ramble. It's different.
Guys.
It is a well thought out rant. I think it's a thing of beauty when you go on a topic like that and it switches midterm. And I'm not even,
No.
again, you know how I feel about you. I think you're brilliant. Yeah, I make no bones about it.
I'm just
Yeah.
gonna go listen to some Led Zeppelin and drink bourbon and tears. So
God,
thanks,
that
guys.
sounds like a fabulous night anyway, though, except for the tears part. Okay. I'll see you guys.
Thank
Have
you
a great
guys so
weekend.
much.
See you, Jimmy.
Thank you.